Welcome to the second session of our virtual 2021 ACCIS Annual Conference. My name is Enrique Velázquez, Director General of ACCIS, the trade association that is the voice of the credit information industry in Europe. On 30th of June, the European Commission is on track to publish its proposal to review the Consumer Credit Directive. One of the elements that the Commission will possibly address is the perceived fragmentation in the EU single market with respect to creditworthiness assessment rules. The assessment of creditworthiness is a process that depends on the successful interaction between lenders on the one side and borrowers on the other side, with the support of credit databases run by credit reference agencies. Assessing creditworthiness adequately is a key component of responsible lending. Now, in a digital data-driven environment, the relevant factors that can be taken into account for the assessment of creditworthiness are evolving. New data, such as regular household bills or open banking transactions, are way more easily and readily available. The ability to leverage new data and new data analytics enables better and quicker credit decisions. However, the use of personal data raises policy issues, including those related to data privacy, data protection, and a potential loss of control and understanding of the dynamics underlying lending decisions. Today, we want to explore with you how data can be put to work to ensure responsible lending for consumers. To advance this important issue, we have invited 5 experts. 2 of them will kick off our debate, each presenting a case study for 10 minutes. I will then invite the additional experts to provide their initial views for 5 minutes each before we open the floor for questions. Some additional information before we begin. Let us make this an interactive discussion. On the right-hand side of your screen, you have a tool called Slido. Use it to send us your questions. Use it also to answer the 2 polls that we're going to run by you. The first one should be now available and will stay open during the next 20 minutes or so. It reads, have you ever asked for a copy of your credit report? Yes or no? With this question, we would like to understand how familiar you are with credit reports. If you do not know what a credit report is and what information it includes, do not forget to visit the website checkyourcreditreport.eu after today's session. Last year, ACCIS put together that website to clarify the role credit reports and credit scores play in the lending process and what consumers can expect from credit reference agencies. One more thing. This is an open event. Please post about it in LinkedIn or tweet about it or both, whatever works for you. It would be great if you could also use the hashtag ACCIS Conference. Before ending these remarks, I would like to remind my speakers to stick to time and help me ensure that we end at 12:30 Central European Time. Today is one of those rare sunny and warm days in Brussels with temperatures exceeding 31 degrees. So we should be indoors the bare minimum. Okay, let me now briefly introduce our first speaker to you. Good morning, John. John Rowley is Global Head of Data Exchange at Experian, one of the largest information services companies in the world. Data Exchange is a global innovation team. John and his colleagues are focused on developing propositions to facilitate access to new and non-traditional data. So your experience, John, is particularly relevant for the topic that we are covering. Today, you will share your views on how to create a fair, safe, and future-proofed credit market. We are all very interested in what you have to say, John, so I would like to give you the floor now. Over to you.
Excellent. Good morning, everyone. Thank you, Enrique. And just another bit of about my background before taking on my current role in Experian. I was also strategy director for the UK business, where I led the implementation of open banking in the UK, where Experian is currently powering over 30% of all open banking transactions in the UK market. So, and I firmly believe credit reference agencies have a critical role to play in creating a safe lending environment around the world. And if we just flick to the next slide, please. I think CRAs have come a long way since they began in the 1950s, 1960s. But in a fast changing world, I feel there's still much ahead of us, and I can see a really exciting future. And I'm lucky in my role that I get to see developments across many different markets, from the most mature to those that are just emerging. And today I wanted just to share 3 key areas that I would believe will be critical to CRAs and also to the fair and efficient functioning of credit markets across the EU. That is inclusion, understanding, and innovation. Next slide. Credit invisibles, which is a phrase to describe those people that are not represented in our traditional credit systems, remain a significant challenge, even in mature markets. For example, in markets such as the US or the UK, typically over 10% of the population are invisible to the mainstream credit systems. And there are many reasons for this. They may be excluded because of a lack of data, because of their previous behaviors, or of personal choice. We also know that demographical, cultural, and lifestyle aspects affect inclusion. And to function fully, markets need to anticipate, recognize, and respond to these. There are a number of changes we need to consider. Younger generations having a lower propensity for credit, significant changes to working patterns, such as the gig economy or phased retirement, and people taking credit later into life, to name but a few. And I've always found it slightly paradoxical that the way to be recognized by credit systems is to take out credit. And this is where I believe alternative, or actually I'd just describe it as new data sources, have a critical role to play. The ability for us to use data that's beyond the walls of our credit systems that actually do more accurately reflect our very varied lifestyles and interests. Open banking is a good example, enabling richer and more timely affordability assessments, for example, in credit decisions. And I know Christian is going to come on and talk about that later. So I wanted to give a few more examples. Within Experian, we've been using new data sources in a number of countries to help consumers demonstrate their creditworthiness to prospective lenders. In Indonesia, we created credit scores for more than 100 million consumers by using their mobile phone data. In the UK, we've enabled more than 2 million social housing tenants to use their rental payment data to enhance their credit score. And in Africa, we've been enabling consumers to build and demonstrate their knowledge of money management to enable them to access credit for the first time. These are just a few of many, but the message for me is clear. By enabling the use of broader data sets, we can make our financial systems fairer and more inclusive. Next slide, please. So let me move to my second point, understanding. For any system to be inclusive, it has to be understood. And it is clear we still have some way to go to help more people understand how our credit systems operate and how the decisions within them are made. Stats on this are rather scarce in the EU, but there are many factors that can influence a low level of understanding. Some cultural, some commercial, some regulatory. And therefore, I believe no one party has the ability to change this. It is something that we must collectively address. And I'm really encouraged by the work that ACCIS is leading in this space, but there's obviously a long way to travel. I wanted to share some developments in other markets to demonstrate what is possible and how from that basis of understanding, you can engender more consumer trust and interaction, albeit I have to caveat it that it is still across the world work in progress. Starting with the UK, consumers in the UK have access to a wide range of credit scores and reports delivered by the CRAs and also through third parties such as ClearScore, Credit Karma, price comparison websites, and a number of lenders. Significant effort has been undertaken by these organizations to educate their customers on how credit decisions are made and how they can prepare themselves and present themselves in the best light. Over the last 4 years, the UK has seen a number of people who have checked their credit report rise from 45% to 54%. And our research shows that those people who proactively engage ultimately present lower risk and are less likely to have any negative consequences down the line. And I wanted to share 3 examples where, having engendered that increased knowledge, that increased trust, and more transparency and control, you can have profound effects. Firstly, eligibility services were introduced into the UK in around 2015. Eligibility helps people find the most appropriate product by showing them which cards, loans, mortgages they are likely to be accepted for without damaging their credit score. Before then, acceptance for credit was somewhat of a gamble. Now in the UK, over 60% of all credit accounts that are opened are preceded by an eligibility check. And in some product lines, such as credit cards, that raises to above 80%. This has made applying for credit feel safer for consumers, and in turn has helped the UK credit market to grow. Recently, we launched Experian Boost in the UK and in the US, a free credit score improvement service that allows people to share their open banking data to boost their credit score. It enables everyday payments to subscription services and regular payments to things like taxes and savings to be taken into consideration. This helps contribute to people's overall financial image and can positively impact changes in securing credit for the future. Since launching in the UK, more than 600,000 people have boosted their score, and this continues to grow by about 100,000 a month. And in South Africa, we launched an app called Galeza. Galeza is a unique financial education and credit scoring mobile app. It uses a combination of gamified financial education and the ability for users to share more information about themselves to create a credit score for the underbanked. The other interesting angle with Galeza is how it's being distributed. Our partners in this initiative are not other financial institutions, but sporting teams like the Kaizer Chiefs football team and the South African Rugby Football Union, who want to help their fans and deepen their relationship with them. Sometimes, as an industry, we've got to go where our consumers and customers are, not expect them to come to us. And these examples show to me that by demystifying what we do, giving people easy to use tools and helping people feel in control, we can help consumers make the right decisions that in turn engenders more trust in our financial system. Next slide, please. So over the last few minutes, I've covered a number of initiatives that have been and are being driven by credit reference agencies. CRAs like Experian have a strong track record in driving innovation in the credit markets in which we operate. Our advantage, unlike some others, and unlike the clients we serve, is that we can focus our innovation on the key areas of credit, identity, and fraud. We all know that the only certainty in life, in the world, is that we will continue to change at pace, and we must see this as an opportunity. And in response, the regulatory regime also needs to develop at pace. We all know that advances in technology, analytics, and the changes that we see in consumers' behavior and expectations present significant opportunities, but also introduce new risks. Advanced analytics, machine learning, artificial intelligence is a case in point. There are many significant success stories where the use of advanced analytics has benefited individuals, businesses, and society at large. But there have also been a number of well-published failures. This doesn't mean that AI is bad and should be shut down. More that we need to recognize that it is new and understand the new risks that it can introduce, such as amplified bias, and how we can mitigate these. This is the key challenge for regulators, to create an environment that both fosters innovation whilst also protecting customers, and to do so at a pace that stays in touch with a fast-moving environment with the flexibility to be future-proof. I'm encouraged by the growth of things like regulatory sandboxes and how regulators are proactively seeking to support innovation in our sector. As we consider what further regulations are needed, my only ask is that we ensure that the decisions are weighted to the size of the opportunity and not the fear of the threat. So as we consider revisions to the CCD, I'm hopeful that the changes will drive inclusion, understanding, and innovation. And I know that CRAs will play a pivotal role in creating a fairer, safer, and future-proofed credit market. Thank you.
Thank you very much, Jon, for this presentation. I just took away some ideas by having or using broader data sets. We can make the financial system fairer. You talked about empowering people, giving them knowledge so that they can take and make more responsible financial decisions, and that engenders trust, and the challenge for the regulators to create a regulatory system that fosters innovation and at the same time protects consumers. So thanks very much for that. You gave us a lot of food for thought that we will explore further in the discussion. Allow me now to move on to my second speaker, my next speaker that is calling from Vienna. Guten Tag, Christian.
Hello, guten Tag, Enrique.
Christian Ochs is the co-founder and CEO of a 5-year-old Austrian company called Fincredible. Christian is going to present a case study concerning the provision of fully digital credit checks on consumers. I am sure that the perspective of a founder will be very valuable. Thank you for being with us today. Christian, the floor is yours.
Thank you very much, Enrique, for the kind introduction, and also to the conference organizers for giving us the opportunity to present this case study here. So I would like to start out with saying that Fincredible is a startup company, much less known to the industry, of course, that has been founded on the basis of a certain idea and firm values, which are very important for the case study and the way our business operates. So I would like to start out with a very, very brief company profile to give you a little bit of background who we are. Next slide, please. Fincredible is a credit reference agency, and we are providing credit checks on consumers based on open banking data. So bank transactions data that Jon already mentioned as well, carried out under the Payment Service Directive 2. So in this sense, we're also an account information service provider. We're licensed with the Austrian Financial Market Authority. So clearly we are industry representatives, but perhaps equally important, who we are critical thinkers. So we are academic researchers working at Vienna University of Economics, where I'm currently located. We're also, and first and foremost, we are concerned consumers ourselves. And we founded our company because we did not like how traditionally data has been collected and credit checks have been carried out. So we wanted to change something. That was our initial idea. I'm not claiming here that we are the sole defenders of consumer rights and data protection advocates. But I have to say that we design all our products by also looking through the eyes of consumers and having certain principles we stick to when conducting our credit checks. And the first principle is that consumers own their data. Well, that's a fact, actually. But they may lend it to us for a limited time period, meaning on every occasion, for every credit check, we ask for the collection of data, we ask for consent for the collection of data and the performance of a credit check. Second, consumer and counterparty, in our view, should receive symmetric information. So there should be no secret. Jon mentioned demystifying credit checks, and we want to level this playing field. Both parties should have equal information. And kind of as a direct consequence, our credit checks have to be understandable by consumers and, of course, by financial service providers as well, to understand the impact of the credit decision. Next slide, please. So by sticking to those principles, we carry out our credit checks. And very, very brief overview how this works is, first, a consumer is invited by a counterparty to a credit check. This is done by the display of this blue button, Start Check, that you see here, that can be either integrated on a website, for example, of a bank, or by notification, WhatsApp message, email, whatever it is. And by clicking on this button, a consumer opens up a pop-up window that asks for disclosure of the data of the consumer and the consent to a credit check. Second step is that the consumer provides the two-factor authentication that is required for us to receive the bank transactions data. And this data is supplied by the bank to us and analyzed. And third, the consumer is displayed the results of the credit check. So the consumer can review the results, comment on the results, and decide to forward the results to the counterparty. So it's to the discretion of the consumer. And I would like to say that the willingness to perform this credit check and also to forward the results of the credit check depends on the benefit of the consumer. So benefits can, of course, be financial benefits. So you get the credit, that's like boosting your score, for example. Could also be that the interest rate is lower as a result. But actually, I'm not focusing on financial benefits here. I'm talking about solving a problem for the consumer. That means could be in terms of convenience and speed of the credit check, but also in terms of the quality of information provided. And this is an important point I would like to make, the financial consulting we provide to the consumer. We explain our data and our credit check to the consumer. We want to help them make the right decisions. So we focus on the consumer value added. Next slide, please. I would like to continue with this point. If we think like Generation Y and Generation Z, which is easy for me because I am Generation Y, I would like to bring you these statistics here by Forbes and Facebook's survey. 90% of consumers of Generation Y and Z expect that they have to make an important financial decision that will impact their lives in the upcoming 3 years. Yet only 8% trust their bank's financial consulting or their own financial literacy. So the consumers feel that they lack the information and tools to make educated decisions. And we would like to change that. Yeah, thanks. So we want to thrive change by challenging the markets and challenging incumbents, but also cooperating with incumbents. So we want to shape the market actively. And by developing our products, we actually found that we share a lot of values with traditional CRAs, credit reference agencies. So we do have different approaches, but we have a common ground. And in our case, we found a team partner in KSV 1870, a traditional CRA with a 150-year long history. And we joined the group of KSV 1870, the company group, because they advocate responsible lending themselves. They contribute to financial education. They go to schools and educate people there. They constantly seek for innovation themselves. They know that something needs to change, the markets change, and they're actually driving innovation themselves, but they're also asked to be challenged. And together we came to the conclusion that we want to enable consumers to take better informed credit decisions. So we decided to team up and develop a joint product. And this joint product is also motivated by a business observation, a business decision actually, in that we observe that markets are evolving. Markets are evolving towards a buyer's market. Consumers today have more options to finance a contract than just by taking out a credit or a loan. Actually, there's a lot of innovation in the market, right? You can take out a loan in many forms and shapes, and there are new players entering the market every day. But also there is leasing. There is now a development that shows that, for example, you don't lease your car, you rent your car again. So renting is the new leasing. Consumers have many options nowadays, from choosing different loans, but also choosing different contracts and kinds of financing. So the market evolves towards a buyer's market, and the consumer position is strengthened. However, we find that consumers still lack the tools and the financial literacy to utilize their position and to make the right decision for themselves. So we really want to change that in providing consumers a trusted certificate to their discretion that contains all credit relevant data. And they should decide what they do with the certificate, where they go with the certificate, to which financial service provider they show it, and what kind of contract they want to conclude with it. And this is done by providing a product that you can simply order online right now. Next slide, please. So this brings me to the product I want to bring forward to you, the InfoPass, a trusted certificate that contains all decision relevant data. There are three components to this InfoPass. That's first self-disclosed data that at a later stage may be verified by us. That contains financial wealth, for example, passport ID information, of course, everything provided voluntarily by the consumer, information about the project to be financed, any corporate or commercial position they have, but also the traditional CRA data by KSV 1870, the credit database, the consumer credit register, bank fraud warning lists, data on delayed payments, probability of defaults, and the score, of course. And the third component is the PSD2 credit check. So we verify the account and the account holder. We verify the employment status and the employer of the consumer. We also can give a suggestion of the household budget, which is not trivial to put together by a consumer, by the way, not even for a financial scholar. I experienced this myself, even though I'm working in the industry. It's non-standardized to have a household budget. Banks request different forms and shapes of it, and it's really not trivial. There are many questions to be asked. And also we can verify this budget, this household budget for the consumer. And last, there are common risk indicators that we, of course, also explain to the consumer on the basis of bank transactions data. So everything, all these three components are structured and explained to the consumer, and it's to the consumer's discretion where to bring this certificate, basically. This new paradigm to empower consumers turns into a big success story for us. So we were able, by offering this product that you can simply order online, to convert the consumer to a paying customer. And consumers are willing to pay for the quality of data they receive and the service provided. We provide financial consulting, basically. The consumer receives a verified and understandable information at their own discretion. And on the other hand, the financial service provider, they show a very broad acceptance of this certificate because they receive a trusted and structured data set, a certificate, everything prepared in advance before actually talking to the consumer or at the discussion itself. So consumers and financial service providers, they have a benefit, there's added value for them, and they can now focus on the more important questions. Instead of collecting different documents and data and clarifying the data, because there are usually many questions asked, they can really discuss the credit specifics. Is it smart for me to take this loan? What are the contract details? There's more time now for the more important questions. So we empower consumers by offering this certificate. I would like to close this case study with a short what's next, because this is also a topic of today's discussion, financial inclusion, and we're currently working on providing a second chance PSD2 credit check for consumers with a credit history for renting, leasing, and lending, so that we avoid financial exclusion of certain consumers that already have maybe a negative entry in credit databases of traditional CRAs. Last, I would like to close my presentation with 3 points actually for discussion in the panel discussion afterwards, kind of a motivation. First is a point on side of the industry. I think we need to change our paradigm. Consumers shouldn't be the subject of our credit checks, but instead they should be the audience. And if we really focus on solving consumers' problems, then we may even be able to convert them to paying customers instead of being just the subject of our credit checks. Second, I think that regulators need to support any change in the industry and also allow for innovation by providing general principles and a future-proof guideline how credit checks should be carried out. So there should be a framework on which data is allowed. That should be financially relevant and well understood data, of course. Should be no discrimination. But it should be general principles and not a rigid rule set. And from my own perspective, I would like to add that it would also be desirable for regulators to remove areas of conflict between different legal norms. From a founder's perspective, without having deep pockets, such as traditional CRAs like Experian, for example, it is very, very difficult to enter into the market. There are areas of conflict between the GDPR, of course, the PSD2, the bank regulation, and many more. And I think it would allow new players to enter the game, basically. CRAs are trust-based, and trust-based business is an obstacle by itself to overcome for new players to enter the market and also to allow for innovation. And last, because we're talking about responsible lending today, I think it's important for the industry and also for the regulators to ensure that the tools and the information to make educated decisions, informed decisions are there. That's true. But also consumers are responsible for using those tools in this decision to make their own informed and responsible decisions. So I think that's something that is easily overlooked. We can make an offer to consumers, but consumers also have to use the tools that we present to them. And by this, I would like to close my presentation. Thank you, and I'm very much looking forward to a vivid discussion.
Thank you very much, Christian, for this very, very informative presentation. There were a lot of elements in your presentation that I liked. The consumer-centric approach, this InfoPass, seems to be a very interesting idea, an example of innovation put forward by the industry. This idea of empowering consumers through knowledge so that they can make better decisions. The cooperation with incumbents, and perhaps that's the way forward for the industry to associate the newcomers and the existing players. So a lot of things, and thanks for your closing remarks, because I think indeed those would trigger a lot of discussion. What happens next? Before we move on to the interventions from the additional experts that we have today with us, I am going to close the poll that is, for the time being, standing, which is in relation to the copies of your credit report, whether you have or not asked ever for a copy of your credit report. So that poll is now closed. I will then present the three speakers in one go. And then once I do that, I will open the second poll. No, sorry, I'm going to change tack. I'm going to open the second poll now so that you do not waste time and can respond while I go through the presentation of the speakers. So you've responded to the first one. The second one, and there are a lot of things that have been discussed already. Do you understand what alternative data is and how it can help to assess your credit worthiness? That's the second question. Very much looking forward to your answers. Now, moving on to the additional experts. We're going to start with Peter Norwood, who is Senior Research and Advocacy Officer at Finance Watch. For those that do not know Finance Watch is a highly regarded European non-governmental organization that conducts research and advocacy on financial regulation. Peter has extensive experience in EU financial services policy. Peter, you have worked for more than 10 years for regulators, institutions and associations. So I think you have sat at every possible side of the table in this discussion. So we very much look forward to your comments. After you speak, we will turn to Chris Meldermans, that is with me here on the studio. Thanks very much for joining me today. Chris is Head of EU Affairs, Corporate Public Affairs at KBC Group. KBC is a Belgian universal multi-channel bank insurer focusing on private clients and SMEs in Belgium, certainly, but also Ireland, Central Europe, and Southeast Asia. Chris is very experienced and very well known on banking matters, particularly retail banking, in Brussels policymaking circles, and trusted and admired colleague. So thanks for being with us today. And we will complete the round of initial interventions with Elena Brolis. Ciao, Elena, who is our policy officer working at DG Just at the Consumer Policy Unit at the European Commission. Elena is the person that leads on the review of the CCD, and therefore is the only person in this room and possibly in the audience that does not need to have a crystal ball to know what's being published on the 30th of June. So you are in that lucky spot. So these will be the three experts that will come next. The second poll will be closed after their initial interventions. And I am going to move on now to Peter. Peter, a lot of things have been said already. You see industry also making comments around what consumers need, how we can empower consumers, but you are here more on the sort of consumer side and the voice of the consumer. A lot of things have been said about what type of data can be used for creditworthiness assessment, what risks there might be, for example, for using certain kinds of data. So a lot of references already to those matters. What's your view on the matter? What's your view on this topic? For 5 minutes, please, Peter.
Right. Thank you very much, Enrique. Irresponsible lending is one of the key drivers of over-indebtedness among consumers. Irresponsible lending is a practice where credit is proposed by a lender, even though the borrower has insufficient financial means to pay it back or has a foreseeable chance to see his or her income diminished during the reimbursement period. One of the key tools to prevent irresponsible lending, and with it the mis-selling of consumer credit, is an accurate and adequate creditworthiness assessment. Ensuring an accurate creditworthiness assessment hinges on the right kind of data being used for the assessment. Having the right kind of data helps in two ways. First, mis-selling of consumer credit can be prevented, and second, financial inclusion can be ensured. If the wrong kind of data is used, however, this can lead to consumers being sold a loan they're unable to afford. That mismatch leads not only to economic hardship, but also health issues and societal strain. It can also lead to financial exclusion. Financial exclusion in this case means consumers being denied a loan not because they're unable to afford it, but because the data used for the assessment is biased and are based on data irrelevant for the assessment. Currently, there are many poorly designed creditworthiness assessments leading to the negative consequences I just outlined. This is an indication that the current CCD rules and creditworthiness assessments fall short. While the CCD requires a creditworthiness assessment to be performed, it does not include any requirements on which information should be used as part of the assessment to ensure that it is accurate. Therefore, in our opinion, there's an urgent need for the legislative text to specify how the assessment should be done and what data should be used. Allow me to share with you now some facts on this from a recently published study from Finance Watch, which highlights the issue that there is a serious problem stemming from poor creditworthiness assessments. Finance Watch data in the study show that in 31% of the cases, information about consumers' budget balance, so the level of income and level of expenditures, is not even asked as a part of the creditworthiness assessment. Moreover, instead of looking at information on the consumer's household budget, some credit providers use irrelevant data, such as consumers' political involvement or opinions expressed on social media. Now, this leads not only to mis-selling, but also can lead to financial exclusion and discrimination. And given the easy access and availability of large amounts of online data on individuals, this is particularly worrying. Our study also suggests that many credit providers fail to use sufficient and verified data for the assessment. In 40% of cases, credit providers ask for less than 4 pieces of information in a declarative form to perform an assessment, meaning they do not ask for supporting documents to verify the information provided. Practitioner and expert feedback from our members across Europe back up our study findings. So the problem is real. This means we need more prescriptive rules in the CCD. And also, there is a need to introduce a rule in the CCD stating that the sale of a consumer credit should be refused if the result of the creditworthiness assessment shows that the consumer is not able to afford the loan. A good creditworthiness assessment is not simply based on past data to deny access to defaulted debtors, which is very often the case nowadays, but analyzes the current and expected financial capacity of the borrower's budget. What is too commonly observed are assessments where, as long as credit history is positive, no default or error is registered, no negative signal is sent when the household budget limit is reached. Therefore, it is crucial that the assessment be based only on assessing the consumer's income and expenditures, as well as data on the consumer's ability to manage their budget, which includes credit and debt installments. To ensure that the assessment is only based on this kind of data, it is crucial that the CCD contains prescriptive rules on what data are to be used. Moreover, there is a need to make clear in the CCD that lenders should only obtain personal data with the owner's informed consent and use that data in line with GDPR principles. With the digital transformation, it has become easier for firms to obtain information about consumers online, for example, through big data, without the consumer's consent. The CCD must guard against this data being used by firms for creditworthiness assessment purposes without the consumer's consent and in a way that goes against the GDPR. Let us use the opportunity of the CCD review to ensure consumers are adequately protected, financially included, and avoid the over-indebtedness problem from further worsening. Time is crucial, as Europe already faces worsening over-indebtedness and a lingering non-performing loan problem that hits vulnerable consumers the most. Thank you very much for your attention.
Thank you very much, Peter, for injecting this radically different, but at the same time, very important perspective into the discussion. I take away from what you have said that in a significant number of instances, creditworthiness assessments are not working properly, that in a significant number of cases, the information that it is collected to perform the creditworthiness assessment is very scarce. Sometimes even wrong data are used for creditworthiness assessment, leading to things like financial exclusion or mis-selling. So thanks for highlighting these problems. What's the situation from the lender's perspective? Chris, I think Peter was also calling for stricter rules clarifying how creditworthiness assessment should work, what type of data should be used, more prescription on this. What's your take on this discussion so far?
Well, Enrico, thank you very much for inviting an incumbent partner. KBC is a bank, and in fact, granting loans used to be a core business for a bank. We have about 90 years experience in that area, and I've been a branch manager for 15 years, so I can speak from practice and experience in that area. I've seen this market evolve from granting loans based on trust, and I'm oversimplifying, but partly based on trust, to today an AI value chain driven decision. Why is there no more further any human intervention or less human intervention than it was in the past? It's partly due to the fact that we live in a regulatory environment. And due to either the Consumer Credit Directive or the Mortgage Credit Directive and the different guidelines we receive from the EBA, we are in fact able to streamline through artificial intelligence a full credit process. At the end of the process, computer says no, or computer says yes, which is not always the outcome that the client wants to see, but that's the way it goes. What have we done? Actually, what we do in the regulatory environment, we define our own credit standards, our own internal standards. We have what we call a credit risk standard for private persons, and we use the abbreviation, it's a CRSPP, and includes all the internal rules in order to come to a sound credit management. And a sound credit management is partly for the protection of ourselves as a bank, but also a sound credit managers to actually prevent over-indebtedness or undue hardship on the side of the ones who are asking for the loan. The fact is that most people don't. Asking for a loan is in many cases an emotional decision. You want to buy that car. You want to buy that house, and it's partly emotional. And when the banks at the end of the story says no, because we think you would be over indebted, then it's very difficult to pass this message to the client because they see this quite differently. So, but we have gold is in an artificial value change, which then in fact takes into account certain considerations, such as all other financial commitments and regular expenses of those clients. Where do we get the information from? Well, we are a bank after all. We have a lot of internal information, that's for sure. We will ask the clients for their payslip, employer confirmation, and we also check credit bureaus in order to see whether there is any indebtedness, credit check indebtedness, or delinquency or at another financial institution. Again, based on this information, and in some of our home markets, we also use the social insurance register. That's the case in Slovakia and Bulgaria, where we have an extra way of informing us. It's really done to see whether the customer is able to repay the loan. Because in the end, if you grant loans, there are only two questions which are important. If I give you the money of our clients, how will you pay this back? That's, in fact, the only thing as a branch manager I need to know. Again, I'm oversimplifying, but that's back to the core activity of granting loans. We have, and I want to react on what Peter says, we have a debt service to income criteria, the DSTI, which actually is calculated to see whether the loan can be granted without risking over-indebtedness or without any undue hardship on the side of the client. In our opinion, it would be good to have a kind of a cross-border European social insurance register where all the banks or all those who want to grant credits can actually get access to data, to the data they need to find out whether or not a loan can be granted. That's not the case. We have a few national social insurance register, but only, as I said, in two of our countries, Slovakia and Bulgaria. It does not exist in the other countries, and maybe we can see whether it's got organized on a national level, but on a European level, that would even be better. But I suppose that this is still a long way to go. So we do our credit assessment according to the EBA guidelines. Contrary to, I think, what Peter has said, we are less keen to see any further tightening of the current regulations. We do think that right now, within the standards of today, you can manage the credit risk substantially. When it comes to input of data, again, we would like to see some more officially or more national or European register where we can find our information, so we don't have to go back each and every time at the client to ask for this information. And maybe contrary to others, we don't use social media to grant loans or to deny loans, because social media, in our view, is something we cannot verify, and we don't rely on any information we can't verify. So we need a double source in order to check what has been published over there. So that's very, in a nutshell, the way we have organized ourselves on granting loans. It's for a bank of extreme importance that that the loans got paid back, because otherwise we go for another directive, which is the NPL directive, and we want to stay away from the NPL directive as far as possible, specifically in the area of retail investors. In the area of corporates, that's a quite different ballgame, but in the area of retail customers, we like to stay away from NPLs as far as possible. But again, this being said, asking for a credit is mostly an emotional decision. You really want that specific object. We really want the loan. And as soon as a bank says, no, we won't grant you that loan because we don't think you're able to repay it, it's a very difficult conversation, and people tend to blame the bank for not having granted that loan, even it's for the better of the customer themselves. So there's always a thin line to walk when you grant loans to whoever it is.
Thank you very much for your remarks. I realize that credit is indeed something quite emotional, and I think most of us had gone through the process of having to ask for a loan, and we know what emotions that generates and what type of conversations you need to have with your branch manager. I take away the fact that the credit management standards that you have protect the bank, but at the same time protect the consumer. They try to avoid that consumer falling into the trap of over indebtedness. The need to have access to more data, perhaps more access to either at the European level or national level when those data facilities don't exist, that there could be progress there. And certainly I think I take away the remark about not using social media data, or more generally data that cannot be verified by the bank and that cannot make much sense. Okay, I think with that we have completed industry, CRAs, consumers, the sort of key players perhaps in the credit ecosystem. We now move on to the regulator. Elena, you come at the end. What do you make of this discussion so far? In fact, I assume that having gone already through the evaluation of the functioning of the Consumer Credit Directive last year and working on the new text, you are quite familiar with the arguments that have been put here on display. Maybe we can have a kind of peek or a sneak preview into what will happen on the 30th? What is it that you're going to publish? If you could reveal anything on in what direction basically this conversation is going at the European Commission.
Thanks, Enrique. So today I'm glad to engage with colleagues and discuss these very interesting topics. Indeed, from a regulatory point of view, to ensure a balance between access for consumers, enabling innovation, of course, but also consumer protection on the other side is not that easy. As you said, so we are building on years of work on the functioning of the current legislation. And also, of course, we are looking at possible future scenarios to prepare the legislative proposal. But so I don't need a crystal ball, but of course the final decision on the legal proposal will be will lie with the College of Commissioners. So maybe even I don't know precisely what will be in the proposal. I just wanted to come back a bit on the Consumer Credit Directive and on the fact that it ensures non-discriminatory access to databases for providers which are established in different member states. But of course, as it was shown by the evaluation, the breadth and depth of information which is collected by databases, of course, both private credit bureaus and public credit registers vary considerably among member states. And as part of the evaluation published last year, but also of the review, which is bringing us to review the directive to change most probably the directive. We have addressed those aspects, and on the one hand, the type of data that creditors collect from consumers, which is traditionally similar across member states. So you have pay slips, questionnaires, account statements, But recently, as was mentioned, has seen the inclusion of alternative information. And this raises serious concerns in terms of data protection, and requires an assessment of proportionality in terms of proportionality. On the other hand, we have looked and are looking at how databases work. What are the constraints in terms of cross-border access? Because, as you know, one of the objectives of the Consumer Credit Directive is to ensure a well-functioning internal market for consumer credit. And so the issue of reciprocity, but also what is the content of the databases. So negative data on defaults, for instance, or positive data, which varies in different member states. So some member states only allow databases to collect negative data, such as defaults of payments, because they consider that the collection of positive data would not be proportionate. So making the collection of positive data by all credit databases compulsory would be probably difficult to implement at union level. And this is linked, of course, to the type of information that should be used for the creditworthiness assessment, and member states are free to decide what kind of information should be used. Of course, in the framework of the current Consumer Credit Directive, but also, as was mentioned, now there are the EBA guidelines on non-origination, and the current directive is principle-based and only asks sufficient information to be used. Of course, another layer is the General Data Protection Regulation, which guides us and establishes a framework for data protection in the EU. So there are different types of creditworthiness assessment carried out in member states, depending on the type of information used, whether it comes from consumers, but also from databases. So now, taking into account that now also, as I said, we have the EBA guidelines on loan origination, setting a framework for establishing data that can be considered for creditworthiness assessment. So a list of information which includes financial and economic circumstances to be taken into account. In the proposal, we want to maintain, first of all, the principle of non-discriminatory access for the database consultation across borders, because we want to prevent any distortion of competition among creditors. But we also want to include some elements to enhance reciprocity while allowing member states to keep the necessary flexibility. So this is a bit where we stand. And I'm very happy to engage with the other speakers in a very interesting conversation.
Okay, very well. Thanks for those comments. I was writing them down, sort of that I do not miss out in the question and answer part. Before we move on to that with the audience, and I am starting to see some questions coming up, I encourage the participants in the debate to ask more questions. We are going to close the second poll that was about the understanding that you have about alternative data and how it can help assess helping the assessment of creditworthiness. Okay, so I will be injecting the results of the two polls a little bit later on. But the first thing I'd like to do is I would like to invite any of the five of you that have already spoken once. If you have anything to say, to react, I think there had been some cross-referencing interventions. Is there anything that you would like to comment on the things that you have already picked up?
Enrique, I don't mind going first. There's a couple of really interesting points. I think one of my observations, actually, from a very diverse group of organisations, is just how much commonality there is in some of the themes that ran through the discussion. So things around, I think, collectively an opportunity to improve, that there is potential to use more data, and that the customer engagement, transparency, and at the right points consent is key. And I think underpinning that, there's also some differences. And that, for me, that for me makes a really good environment, actually, because we shouldn't all be thinking the same. So actually, I think that that's a really positive backdrop as we move forward. Just a couple of specifics I wanted to build on. Christian mentioned about the benefit to the customer, which is absolutely key. And there's a lot of talk around the use of a phrase around the value exchange for consumers. Completely agree with that. But just to add to it, the research that we've done, which we call the consent equation, just brings another dimension into play, that when consumers are making these choices, they are weighing up the perceived value over the perceived risk. And actually, as organizations, we have to do more to address those perceived risks and to help our customers understand them and either reduce them or eliminate them. So that was one. The other point, wanted to pick up on a couple of points from Peter, was I completely agree, and the definition of creditworthiness is around both someone's sort of behavior and willingness to repay, and critically their ability to repay. Where I deviate slightly is I'm worried that too much rigidity in the data that can be used will both, one, hamper the customer experience. I think Elena used the word proportionality, which I think is right. Different situations, different customers, different product lines, different values require different levels, types of data. And I also worry that too much would reduce innovation and hamper our ability to continue to innovate and improve.
Thank you very much, John. Any other participant would like to comment? Christian, would you like to react to what John's comments?
Yeah, I'm very happy to react. So I kind of agree with John, and I think there's really a common ground. There's nothing I could say against his points. Actually, I can only add to them. But I would like to add to the last point. And my question would be maybe to Peter, how he would imagine how creditworthiness assessment should be conducted in a practical setting. Because what John just mentioned is that for every customer and every business case, essentially, ideally, you have different sorts of creditworthiness assessments. And I would think about, for example, maybe a really small loan, a payday loan or something like that. Let's say maybe just 1,000 euros or 2,000 euros, okay? So if I was asked to fill out now open banking initiative aside, yeah, if I was asked to fill out a household budget and go through a financial consulting process with an employee from a bank, no offense, but I wouldn't do it. I mean, that would be such a pain for me personally, to go to a bank and then to spend an hour talking to someone just to have, sorry, yeah, no offense, but just to have a small loan granted. I wouldn't do it. So I would rather prefer actually some traditional CRA, maybe checking my creditworthiness than to do that. And actually, there is the survey I presented to you. There's another statistics that says basically the vast majority of younger people would rather go to a dentist than to their own bank discussing their finances. So I really wonder how that would work out in a practical example.
I think there's a balance between convenience, proportionality. Would you like to react? Well, Peter, maybe you would like to chip in first. Peter, if there's anything that you'd like to comment, you've been mentioned by John in his reaction. And then I go over to you, Chris.
Yes, thank you very much, Enrique. For one, I think, it cannot be justified to be using any kind of data outside of, payment account data, which includes, incomes, expenditures, credits and debts, using any kind of information apart from that. I see no relevance whatsoever for creditworthiness assessment, just in response to to Christian and John, things such as, somebody's gender or their past addresses or their political views, etc., etc. There is no relevance for that whatsoever. So with that, I disagree in that, we cannot, clearly define what kind of data should be used. Then on the second point, in terms of how this could practically look like, for Finance Watch, we actually published a report earlier this year on this. Actually, where we put forward that with, and this has already been mentioned by some of the speakers as well, the PSD2 and open banking actually opens up a very good opportunity to perform creditworthiness assessments practically in a very easy way, in a very low cost way as well. And what we're proposing here, our idea would be that with the consumer's consent via third-party aggregators, and these third-party aggregators could actually also be existing credit bureaus, existing credit reference agencies, that they could retrieve that information from open banking on the consumer's payment accounts, and then perform a creditworthiness assessment based on that, and pass that then along to the financial institution by the creditor. A very low cost way, a very easy way, very innovative way. And we think that this could be a very, very good opportunity.
Mm-hmm. Okay. They are participants inviting you perhaps to react on how creditworthiness assessments should work, and with another point that Peter was making about perhaps sticking simply to payments data, open banking data. What do you think about that?
Well, I first wanted to react to what Christian has been saying. It's very unfortunate, probably with your bank, that you have to go through an assessment of more than 1 hour to be granted the loan of 2,000 euros. I really pity that. If you work with KBC and we have your data, the only thing you have to do is you have to open your app, ask for a loan of 2,000 euros, and they will say immediately, yes, granted, or no, not granted. It takes you, if I do it, it takes me 5 minutes. If you do it, it will take you 2 or 3 minutes. The only thing you receive afterwards is a call from, not from an avatar, but from a real person, asking you whether you want to have the money now, instantaneously, really instantaneously with an instant payment, or whether you want to have the money at any other time. So I can't speak for all banks, but I can only speak for KBC. And in our case, it's a completely AI-driven value change, no human intervention. So it is on the spot that you are granted your loan or not granted your loan. And the fact when it's not granted is due to the fact that the data don't allow us to grant the loan for those specific reasons, which are the repayment of it, your personal capacity. So I fully must, for our bank, disagree on what you have been saying. And I think not only for KBC, but for an awful lot of banks, they have actually, to a large extent, digitalized their credit granting. Of course, if you come back for 500 million, then I would surely invite you to have a deep going conversation. And you're going to tell me, first of all, why you need the money for, and secondly, how you're going to pay it back. so that's a different ballgame. But I see you want to react to this.
Yeah, sorry, I just want to clear up this point. I know that this is the current implementation. Actually, many banks actually offer that 5-minute loan basically for 2,000 euros or even more. Than that, I think up to 15,000. But I was just, my point was, if a change in regulation may change actually this kind of process, this instantaneous credit, granting me credit. For example, if Peter would suggest, and I'm not implying that he does, but if Peter would suggest a detailed household budget needs to be the basis for a credit check, then perhaps your process would break down, right? Because then I would have to sit together maybe with someone that helps me fill out the household budget. Even with PSD2, there are limitations to the technology, by the way, and to the data. Even if we have the perfect technology, there are limitations to PSD2 as well. I just want to make people aware of that as well. And then this wouldn't work, because then you would actually break innovation, and then everyone comes back to the bank and has to talk to, well, a financial consultant to go through all the documents with me. So I know that the current products you have in place are way more efficient, but I'm afraid that a change in regulation may actually change that.
I fully agree on that one. And this always was my point, that, as I said, we think that right now the regulation and the EBA guidelines are fair enough and good enough to do a proper credit assessment. So indeed, we don't like to see any further tightening of the regulation, because, as you said, this might hamper the innovation process, or even put us back into a situation where we don't want to be. Because in fact, I'm going to say something extremely brutal, but we don't want to see those clients in the office. We want to use that time for doing something else. So that would be a very, very unfortunate evolution if, due to further regulation, this innovation which is now being installed would be hampered. And on that respect, I fully agree on what you have been saying.
I'd like to pick up on the point that Peter made about using household income and expenditure data for creditworthiness assessment. Is there any evidence that alone is better for creditworthiness assessment than that and credit data, for example?
It may not be better that alone, but it's definitely an essential part of your assessment.
So we're talking about a combination of elements here.
Yeah. In our case, verifiable elements.
Okay. I'm already introducing some questions from the audience, but perhaps before we move on with those questions, I'd like to show to you the results of the first poll, which is the one about, have you ever checked your credit report? Because that is an indication of to what extent the audience is familiar with the discussion that we're having. So if we could go back to the results. Yeah, I can see them here. 68% of the people in the audience have asked for a copy of the credit report, and 32 have not. So we have an audience that it is familiar with credit reports. Maybe it's an audience that is interested in this discussion. It's not a very sort of representative sample of the whole general population. Okay, so people seem to understand, which goes back to the idea of empowering people, educating people, understanding of the industry, which is very much with tallies with the comments that John made. I would like to talk a little bit about what Elena was saying about, and you also alluded to that, the fragmentation as to the availability of data in the single market, that in some countries we have more data than in others. In some countries we have positive and negative data. In some other countries, only negative data. And Elena, you mentioned that it would be not perhaps very feasible to force the collection of certain categories of data if there are national barriers or something like that would prevent this. So what to do then about this? I mean, do you see a way to sort of progress the data availability across the single market so that those countries that are lagging behind somehow and have lenders there have less access to data could eventually have more, or is it just a stumbling block that we cannot do anything about?
So as regards, thank you, Ricky, for the question, first of all. I think that it would be difficult to make the collection of positive data compulsory for all member states. This probably is an issue that should be settled at member state level. However, we could introduce some elements in the legislation to enhance reciprocity and also keep a flexible approach, which is something that that was also mentioned, that we don't want too strict regulation. And if I can go back to some of the points raised by other panelists, so it was very interesting to hear about consumer empowerment. So the need, for instance, from Christian, the need that to enable consumer to make better informed credit decisions. But it's also, I think it should be good to be stressed. It should be good to stress that the creditworthiness assessment is done by the creditor, and it's a responsibility of the creditor. This is why we speak about responsible lending. And I very much like the point raised by Chris on verifiable information. So, of course, the consumer should be empowered to understand the process and to participate, of course, providing data. It's great to see that the audience, that the large majority of the audience asked about their credit registers. Clearly, we have an empowered set of consumers here. I'm not sure it's always the case, and this is why also consumer financial education was mentioned before. This is something on which the Commission is investing as well. But it's good to stress that the responsibility lies with the creditor, and to link to this element. Of course, now in the digital context, we are used to fast decisions, and also the preferences of the consumers are for end-to-end processes which are quick. But it's also true that the consumer should also have the time to process information and understand what decision and what the decision is he or she is making, and what are the consequences of that decision. So this is why in the current directive, pre-contractual information should be provided in good time before the credit contract is concluded. This is not always the case, but this should ensure that consumers fully grasp the consequences of the choice they're making, which could engage them for several months or years. And also potentially compare offers, which is something that digitally can be done much more easily, of course. This is one of the advantages of the digital environment.
Thanks for those comments. I'd like to perhaps pick up on what you have just said about the EVA guidelines, and check perhaps with Peter, what's your take on the EVA guidelines? Whether you think that they already provide a framework to operate creditworthiness assessments in a robust way, because you talk about prescriptive guidelines, of course, rules. You use the word rules, and the guidelines are just recommendations. Would you like to see those guidelines be turned into rules? Or would you even change those guidelines and you're not satisfied with their content? So I guess it's a dual question on the content of the guidelines and then on the legal force of those guidelines.
Right, so I think that the guidelines definitely go in the right direction, and actually in terms of the spirit is very much aligned with also the things that I've said today. However, I think it's not enough for it just to be guidelines. I think it has to be enshrined in level 1. I can give the reason, for why. Well, these guidelines are in existence already now. They have been in existence for a while, but despite them being in existence, we're still seeing all of these problems. For example, also that I highlighted today from our study in terms of poor creditworthiness assessments. So I think that clearly shows, and that's evidence enough that just having, soft law here, guidelines, is not enough. And this has to be, enshrined then in the level 1.
Please, Chris, yes.
I know that guidelines are so-called soft law, but that's not the way how we look at it. Whether it's a level 1 or level 2, in the bank I'm working for, the financial conglomerate I'm working for, we don't make any difference. It's EBA guidelines for us are the same as a level 1 decision. So I think if we're talking about creditworthiness, banks are not the only ones who are granting loans. We're only doing this for about 90 years and we're still in business, so I suppose we have certain experience. But maybe not everybody takes into account the EBA guidelines, but for us it's very simple. Guidelines or level 1 legislation, it needs to be complied with, full stop. And there are no exceptions granted. So it's not negotiable for KBC.
Possibly it is also part of the supervisory dialogue that you have with the authorities. If they look at the guidelines and they will check on your operations based on those guidelines?
We cannot and we don't have the intention. I mean, those guidelines are to be implemented. We have to comply to the guidelines, and everything else is not negotiable. It's as I said, it doesn't make any difference whether it's a level 1 or level 2. But yeah, you're absolutely right. It's so-called soft law, but that's a very thin line for a bank to walk. We don't walk it anyway.
Thank you for this, I think, very useful perspective. There is a question coming from the audience for Christian, and it has to do with the info pass. So perhaps you can clarify to this member of the audience, how do you verify the validity and accuracy of the data coming from the consumer in the info pass? I think, for example, the consumer's financial wealth. You talk a little bit about that, but you didn't expand.
Yeah, sure. So there was simply no time to explain it in detail. But there are two types of data categories. So one is, of course, that the consumer discloses data voluntarily, but it's not verified. It's just it's really a self-disclosure. And then there is other type of data that we can verify by looking at the consumer's bank transactions data. And that's, of course, only financially relevant data. So we do not verify spending behavior or something like that. It's really just related to the household budget, to the data that the consumer discloses, for example, regarding the employer and employment position, maybe. And of course, there are the databases of KSV 1870, and they may also verify the ID, for example, the address of the consumer, to basically state this as trusted and verified information on the InfoPass. But other than that, we really look only at financially relevant data. And if that's just a sort of extra information the consumer discloses, this is, of course, then or also told in the InfoPass in the document that this is consumer provided information.
Okay.
All relevant, financially relevant data, we can, of course, verify and validate.
Okay, thanks for the clarification. I'm going to project the results of the second poll. We're coming towards the end, but it was about alternative data, and I would like just perhaps to go back to that last topic. So I'll read it out for you. We're asking colleagues, do you understand what alternative data is and how it can help to assess your creditworthiness? People had to say whether they had a good understanding or a bad understanding, and people had to plot themselves on a bar. 43% of the people know what alternative data is and how it can help to assess creditworthiness assessment. 43 really mark 5, so they are really experts. Again, we have a very expert audience. And 35 marked 4, so we have over 75% of the people that really know what alternative data is. Now, my question to the audience, if we would have additional polls, is what do you mean by alternative data? What do you have in mind? And already in the conversation today with you, I think we have made some progress there. I think open banking, it seems to me that we all consider it as a valuable source for assessing creditworthiness assessment, which is away perhaps from the traditional credit data information. Social media is discarded. You mentioned as a lender, you do not use it. I think Peter also said that there had been examples of this. Perhaps I hope they are in a small minority, and certainly perhaps not traditional lenders or traditional sort of players in the credit information space. So again, I think social media is discarded. And you made a point also about relevance, the relevant financial information, the relevant financial data. So maybe I could ask Jon to give us some examples of the kind of data that you and your team think that could be perhaps be useful. You already talk about rental data, if I recall correctly from your conversation. So can you just give us and the audience some examples of the kind of data that you think can be useful for creditworthiness assessment?
Yeah, Enrico, and I think open banking is really a new and very valuable data source. From my experiences of the last 6 or so years, one thing it isn't is a panacea. It works very complementary with other data sources. And one of the things that you have to design a customer-centric solution, you have to put yourself in the shoes of the customer. So you have to think about their experiences, and you have to think where their data is currently housed, or actually in reality, where their data is currently trapped, and how you can help them free that data to make a better presentation of themselves. Some of the other things beyond what I put in our presentation that we're working with is income data. So for example, payslips, payroll data, being able for employers to permission their employees to get access to their payroll systems and electronically transfer their payslip to a lender. Again, just an easy way of providing evidence of what I earn. And sometimes, and give again the proportionality, what I earn is more important than what I spend. And therefore that is a risk decision for to be based. Other areas that we have looked at and do look at, I completely agree with social media. We have looked at social media data. It isn't the right source of data to be used for many number of reasons. But actually understanding someone's attitude and knowledge of financial money management is. So in some instances, understanding my sort of a form of very simple psychometric testing, it could be used, but using something, it could be music, it could be pictures, is a way to understand whether someone's attitude to money and whether their ability to take on the risk that they are taking on by taking credit. And another source that particularly it has resonated very strongly, particularly with the younger generations, is the data that I hold on my phone. It is a strong representation of my life and how I behave. And actually they are more willing to share that data than sometimes their financial information. It feels, bizarrely to maybe some people, but our research says it feels less personal than my bank account. And therefore, as long as it gives a fair representation of me, then I'm willing to share it. So they're just some of the different types of data. But I suppose our quest is always to find where that data is trapped and how we can free it up. And that's my point around too much rigidity. If you just conclude that this is the data set, then you will not drive that innovation and you will not create the breadth of choice that is necessary for the breadth of individuals that we have in the world.
Thanks very much for that remark and for illustrating the types of data sets. Christian, you want to intervene? We're coming to the end, but
yeah,
if you
sorry, one last question. John mentioned the music I'm listening to may tell something about my financial education. Actually, I would strongly object. I really don't know what it means. Or also my mobile phone, perhaps. So social media aside, maybe you said, but this is something I would not regard as alternative data. For me, alternative data is something that is financially relevant, like open banking data that we kind of can agree on. But someone really has to explain to me why a certain or a particular band tells something about my education. I'm really not sure. So, for example, my small daughter, she would probably understand that everything else remaining stable, that if I increase her income, she would probably have a better creditworthiness. But if she listens to death metal, for example, why would she not be financially well educated? And this is something I really don't understand.
Yeah, no, and in principle, Christian, look, I'm actually 100% agree with you, because actually one of the tests that we will always apply is that explainability, and you're absolutely right. If it doesn't make sense, you can't use it. So actually, if it does not make sense to the people that we're trying to help, then it falls flat, and that is a 100% acid test. And for example, I know with the work that we've done in open banking, there are at least 200 predictive signals within open banking. When we have launched our Boost product in the UK, we've used 7, because those 7 are the ones that are most easily explainable. Now, we may find ways to explain and get to 10 or maybe 12 over time, but you're absolutely right. That is the challenge. So I'm not saying let's create a Wild West out there that everything becomes usable. Everything has to have the explainability test, but let's not constrain ourselves to such an extent that we hamper innovation.
I would only add to that explainable doesn't mean it's well understood, right? So, for example, explainable, if I have an iPhone, some people explain that I must have a higher income, and that's why I have a higher creditworthiness. So that's explainable, but it's not well understood, and so I wouldn't use it. That would be one example, or my operating system or something like that. So I would add to that explainable and well understood as well. And also in economic terms, well understood. There should be really a theory behind it, and it shouldn't be just a spurious pattern you detect with some statistical test, right?
Yeah, and actually, and again, you're right, because as what we know, because I spend a lot of time in this space, is people are ever increasingly aware of their data and their data footprint, and have this. Have a rightly sort of a barrier and concern over privacy and judgment and how they're being perceived. If you don't do it right, they won't use it. So actually, it becomes a full commercial value as well. So.
Okay. We need to bring the discussion to an end because we are already overrunning 1 minute. I know that, Peter, you were waving, I think, your hand at me. Maybe you had something to say, but hopefully I can capture that somehow in my concluding remarks. So very quickly, concluding remarks, at least from my side, what I took away from the discussion, and then I'll give you just the opportunity to correct me. There is value in alternative data, but clearly not all data is relevant and explainable and can be easily understood. So we need to still continue the discussion to fine-tune and refine that. I'm not sure that we need strict rules on creditworthiness assessments. I think the direction of travel of the EVA guidelines is supported by the majority here. Now, whether they become rules or they stay as guidelines, or they stay formally as guidance, but we stick to them as if they were rules, that's a different story. Same thing as to the data that has to be used for creditworthiness assessment. I also take away that there are limitations as to how much the Commission can advocate for the use of positive information, but promoting it, I think, already, and talking about it and looking into perhaps the access to databases on a consistent way across a single market is already very good. It sends the strong signal that positive data, it is important. I think I can stop here. I would like to first also apologize to the members of the audience that have, towards the end of our conversation, started to send us questions. We didn't have the time to respond to those. I think those questions are kept, and I'll go through them and try to respond to those questions or channel the questions to some of the speakers. So if you could make yourselves available just to respond to those, it would be great. And then with that, I would like to thank all of you for your time today and for your very insightful contributions, and the audience for their questions. And I wish you a very nice day, it is happening outside. So Chris and I, we're going to go outside just to enjoy the wonderful sun, the wonderful Brussels sun. So thanks for that. We reconvene tomorrow morning at 9 o'clock for the third session of our ACCIS conference. We have a very interesting session transitioning from open banking that we discussed today to open finance, which is looming ahead. It's the future. And for those that still have time, go on to the networking tool of our conference platform on the right-hand side, and networking will start now. So thank you very much, and see you tomorrow.
Thank you very much.
Thank you.
Thank you.